Hello everyone, I'm Cory Mitchell with TradeThatSwing.com, and in this video we're going to look at how to trade part-time. This is where most traders are at in terms of their trading. They're looking to maybe trade in the evenings or in the morning before they go to work, or maybe they're just starting out trading, so they want to develop some consistency and some potential profits before trying to make it into a career. So in this video I've just compiled some thoughts on your best approaches when trading part-time, what markets to focus on, different trading styles, and basically just how to improve efficiently. So how to trade, the basics. First, let's look at, is trading part-time or trading at all? Is it even possible to make money? And the answer is yes. We're going to talk about some of the statistics and why it ends up being so difficult. But if you can get your head around the concepts we're going to discuss in this video, then yes, it is possible. Is it easy? No. I think anything worthwhile is going to take some work. Being good at anything takes some work. So it's not an easy path. Most people think they just have to, read about a strategy online, go and try to implement it, and they're going to be a great trader, and that's just not the case. Generally, we find it takes 6 months to a year, or even longer for some people, just to master one strategy. Because, as we'll talk about in this course, it's not just knowing when to hit the buy and sell button, it's also knowing when not to trade, also realizing some of your own internal things that are going on, mistakes that we commonly make, and having to correct those. So there's a lot that goes into it, which means it's not easy, but yes, it is possible. Independent traders should really be part-time. There's no need to trade all day. So even though I've been doing this for 20 years, I'm still technically a part-time trader, because when I day trade, I'm only day trading for about half an hour, maybe up to 2 hours. And when I'm swing trading, I run a scan basically once, maybe twice a week if I'm looking at a couple different scans, and placing trades in the evening when the market's closed. Like, that's how I like to do it. And so it doesn't take up a ton of time. That's the end result, is that you're just getting in there, you're trading for a little bit, you're day trading, you're swing trading, but there is a learning curve, and we'll talk about that a little bit later on, because that is going to require more time. The common question I get asked is, well, should I start out day trading? Should I start out swing trading? Should I start out investing? They're all good. There are people who make great incomes and are successful in all of these fields. If we wanted to differentiate, though, between them, one thing that I find from a lot of my students and people who take my courses is that the swing trading and investing, you have a time delay between what you do and the result. And you're also going to tend to have fewer trades. So over the course of a month, if you're a swing trader, maybe you have a few trades to analyze. If you're an investor, after a year, you might only have several trades to analyze. With day trading, you get that feedback much quicker. You might have 2 or 3 trades in a hour session that you can then analyze and see, okay, where am I making mistakes? So the feedback is a little bit quicker. I started out as a day trader, and I have no regrets for that. I think it was a good way to learn how to place orders, learn a little bit about myself. So I found that a good approach. Yet at the same time, it depends on your personality, your time frame, what's going on in your life. You may not be able to, set aside a specific hour of the day to day trade. And if that's the case, then swing trading, investing, all great ways to make some money part-time, or potentially get to the point where you're making some money part-time. So none of these, I would say, are better than another. It's what fits your life right now and what allows you to start making progress today. If you can only swing trade, then swing trade. If you can only day trade, you have that specific hour and it suits your personality, then day trade. If you're more into looking at the longer term stuff, then look at investing. They're all good. Should you focus on stocks, forex, futures? Again, they're all good. You have people who make great incomes in stocks, forex, futures, all of them. Options, I don't day trade options or even really swing trade options that much, so I haven't put it down there. But still, that market, they're all good markets in their own way. And again, I would focus on what you're interested in, what's going to keep your interest. Don't just pick something because someone else tells you to. They're all good markets, and pick what you're most interested in. And if you happen to have come across a trading style or a method, then that suits your personality, and it happens to be a futures strategy or a forex strategy or a stock strategy, then go with that. What you'll find is that you can often just tweak things a little bit. Like my day trading methods can be used in stocks, they can be used in forex, they can be used in futures. We're just going to have to adapt our position sizes a little bit, maybe our targets a little bit. But generally, we can translate a method. If you've found a method that you like and you like a little market a little bit better, you can generally tweak that a little bit to fit that market. How much time is required? So we have two things we have to look at. There is the learning phase and the trading phase. So the learning phase is where you're starting out and you don't really know anything. You're learning a specific strategy. That can take up a fair bit of time. Like we said, it can take 6 months to a year to get good at implementing a strategy. During that early learning phase, you're going to be doing your trading or your demo trading or your back testing. That's going to take up, an hour or two if you're day trading or even swing trading, looking through charts, looking through historical examples. But then you're also going to want to do reviews of your trades, noting where your mistakes are. We're going to talk about some of this a little bit more in depth in the next few slides. So you're going to be putting in some extra hours just because you need to do a lot of work on, like I said, where you're making mistakes, where maybe you didn't recognize a pattern correctly, or just finding ways to improve on what you're doing. So we'll talk about that a little bit later on too, but it's really important to look at your trades and see, like, okay, I'm using this basic method that I learned or that I made up. My results are okay. Looking through those trades, how could they be better? Am I leaving some money on the table on lots of these trades? Can my profit targets be a little bit better? Why is my stop loss so far away from my entry point? What could I decrease that to decrease my risk? Things like that can really help us. And when we're first starting out, there's going to be a ton of that because we just make lots of mistakes and we haven't really fine-tuned our method fully yet. So expect to put in extra hours during that phase. During the trading phase, we're still going to be have our time set aside for trading plus some time for review, but the time requirement is a lot less because we've already worked on a lot of our mistakes. We've already found ways to improve our strategies and we're happy with the results. So if you're a day trader during that learning phase, you might have to put in several hours a day in overall work on our trading and ourselves through that. Over the course of a week, we might be putting in several hours a day on average. Whereas once we get a little bit better, we're putting in that hour a day to day trade plus maybe half an hour or an hour on the weekend just to go over some trades and see if we can improve. So we've really knocked off a bunch of hours during the week because we no longer have to learn as much and we don't have to review ourselves or correct ourselves as much. So how to trade part-time. Efficiency is really important. So I've just compiled some tips that I think, right off the bat, you should try to implement. create a routine. I have a couple different routines. I have a pre-trade routine, which gets me into the proper mind frame, reminds me what I'm supposed to be focusing on. We'll talk about that in the next few slides. And then I also have a daily routine, which kind of keeps me moving efficiently from task to task. And so think about your day, think about what time you have available, what you're trying to accomplish in your trading, and create some of these routines. So when will you trade? Set the hours that you're going to trade. I like trading at the same time each day, or if you're swing trading, you can put your trades out ideally at the same time each day. I like to put them out during when the stock market's closed, or if I'm trading Forex, I like to put them out after the US has closed and before Europe has opened. And so I've just found that works good for me. And yeah, so consider these types of things. When will you trade? And then how will you find your trades is basically your scanning process, or you're looking for trades. If you're day trading and you're just focusing on one pair, like the Euro USD, which I often do, or I trade stocks and they're the same ones throughout the week, then we don't really need to do that. We want to write down why we've chosen those things and how we ended up at that trading those things. But after that, we don't really need to do anything new per se, because we're trading the same things. So how you prepare for trading. Anytime we scan, look for trading opportunities or place trades. So this goes back to that pre-trade routine, where it's not just when I sit down to actually trade. If I'm going to run a scan for stocks that I might trade, I want to be in a good mind frame for that. So I'm going to go through a pre-trade routine, and I'll put links below this video in the description of my pre-trade routine and all that, so you can look through them, my daily routine, so you can look through them and start to create your own. Because if we run a scan and we're in, let's say, a very aggressive mind frame, our watch list is going to end up being huge, or we're kind of in a FOMO state where we don't want to miss out on anything. Our watch list is going to end up being huge because we look at everything as, oh, well, that could go. Oh, well, that could have a big run. Oh, that could have a big run. Or if we're too timid, we might look at everything and say, yeah, that's probably going to be a loser. That's probably going to be a loser. So we want to get into this state where even if we're just scanning, and especially before we actually place trades, I like to be in a state which I call neutral, which is I've focused just on, okay, the objective here is simply to find patterns. I do not control the result. I am just looking for stocks that meet my specific strategy, and then create a watch list from that. And then if they meet the criteria for an entry, I take that trade, because I don't control the result. I can only control implementing my method. And that requires a mind frame that is focused on that, not on the results. Focus on one strategy, maybe two, to start. A big problem I see with new traders is that they are just absorbing so much information, thinking that this is going to make them a good trader, and it is not. If you get good at one strategy, you can make a living. If you know a lot but don't know how to implement it very well, you will not make any money. So we want to focus on one, maybe two strategies if they're, you can keep your head around it, and maybe they're somewhat kind of related or have similar concepts. Because focusing in is going to allow us to make more money than trying to implement a whole bunch of things. You can think of it as the more strategies you kind of have going on, and the more information you're trying to always absorb, the more voices in your head. And you've probably had that experience while trading, where you're like constantly in this, oh, I should take this trade, no, I shouldn't, this person said this other person said this MACD strategy says to buy, this other strategy says to sell. and we have this constant bombardment of voices telling us to do different things. If we focus on one strategy and we get really good at it and we get confident in it, then all of a sudden a lot of those voices tend to go away and we can much better implement that one strategy and start making money. You can always add in more strategies down the road, but get good at one, then get good at another, then get good at another. That's how the pros got there. They didn't learn 10 strategies at once and implement them all, even though now they might be trading 10 strategies. I have several for day trading, I have several for swing trading, I have different ones for investing. It looks like I have all these strategies, but I learned them or got better at them one at a time. So just because someone's implementing 10 strategies now doesn't mean that's how they started. Look at your own trades, see how they could be improved. This creates self-sufficiency, which I think is what a lot of people want. They don't want to be dependent on someone else. And we talked a little bit about this earlier. You can look at what trades when I take a trade in this certain context, it tends to lose more often. We'd have to look at a whole bunch of our trades and try to find these little things. Maybe we have a strategy that buys on a trending market, but we found that if we buy it as the price approaches a prior high, maybe that loses. And I'm not saying that's the case. I'm just saying you might notice that in your trading, and then you can look at more examples of that trade and say, oh yeah, like I lose like 70% of those trades I take. I'm just going to knock them out. Now, all of a sudden, you've knocked out, a bunch of losing trades, which increases your overall profitability. And you might also look at, you've been using a reward to risk of, let's say, 2 to 1. And, you're risking $100 to make $200. But you look through all your trades and you've actually found, like, wow, actually my entries seem to be really good because the price almost always moves through my target by at least a little bit. So maybe you could increase your reward to risk 2.1 to 1. Right now you've just increased that little bit, or 2.2 to 1. Now you're actually making 10% more than you were before, just by because you were making 2 to 1 before. Now you're making 2.2 to 1. That's going to make a difference in your overall profitability. You might notice your stop losses are too far and that you could actually move them closer to the entry price, because if they drop to the stop loss on a small one, they would have hit the big one anyway. So if you notice something like that, you could reduce your stop loss, make it smaller, which then is going to increase your risk reward, right? Because your stop loss is now smaller, and if you can still catch those same runs you were catching before, all of a sudden your risk reward improves. So you want to look at your own trades and see how you could improve. One of the traps here is that people look at other people's trades. Those are not the trades you took. You have a mind that is somehow and some way predisposed to those trades that you took. So looking at my chart and how I handled the situation may not necessarily be best for you, because you might have something else going on. Here's an example. Let's say I've noticed that I've been getting stopped out just a hair early before the move. So, I get in, the price whipsaws around a little bit, stops me out, and then runs. So the trades that I've ended up in, I've actually had maybe too small of a stop loss. So my goal might actually be to increase my stop loss a little bit. On the other hand, the trades you've taken, and I might write an article about this. I might say, based on this, I'm increasing, or I might make a note on my chart, like I'm increasing my stop loss a little bit. And then you look at my chart and say, that's a good idea. I'll increase my stop loss too. But actually, if you looked at your specific trades that you took, you might actually find that you could reduce your stop loss because you've been giving it too much room. Or I might skip a trade because I've been super aggressive lately and I've been over trading. And now I skip a trade and someone looking at my charts thinks, Cory skipped that trade. I should skip that trade too. But if you haven't been, maybe you've been super conservative and it was a good opportunity, but I just had to really back off because my impulses were getting a little out of control. Of course, we have to back ourselves off. There's no one else that's going to. So we have to come up with ways to try to get ourselves back to neutral. And so you might have been super conservative and you took that trade because it was good, and then you see I didn't, and then all of a sudden you're in your own head again thinking, oh, like, I did it again, I overtraded, I shouldn't have. But you were actually under trading to begin with, so that was a good trade for you to take if it was a high quality one. So our mind frame is always going to affect our trading a little bit, even if we're following a pretty systematic method. Even systematic traders talk about how they have times where they turn off their algorithms because they're worried about results or something like that. So even though they're not doing the actual trades, automated method is, they still have control of that on and off button for the algorithm, which affects their results. And so we always want to look at what we're doing as opposed to necessarily looking at someone else's trades. When not to trade has more impact on overall results than taking action. So everyone wants to learn, when do I enter, when do I exit? Not many people are asking, well, when shouldn't I trade? And that's the most important question, because if you have $10,000 sitting in that account and you do nothing, you're going to have $10,000, and as we'll talk about in a little bit, you're better off than about 85% of traders out there. If you do nothing, you'll still have your money, whereas most people will end up losing it and dwindling it away when they trade when they're not supposed to. So you have a method, and you're going to want to come up with rules for when not to trade. So we talked a little bit about that here. If you notice certain times that your strategy doesn't work as well, or you tend to have more losses, you really want to document those situations and then make notes, look at your results, and decide, should I just avoid those types of trades in that situation altogether? And more often than not, if you've noticed that you're losing in those situations, you would want to do that. Modify methods to suit you. Make your trading work for you, not the other way around. So as I said, I choose a time I want to trade, and then I modify my methods around that. I decide I want to place my swing trades in the evening when the market's closed. That means, obviously the market's not open, so I'm going to have to put out certain order types that catch a breakout when it happens, or so I have to modify my method a little bit for that. If you're trading during the day and actually watching your chart, then you can just click your buy button. So there's slight variations in strategy that you can change just based on order types and things like that, and I highly advise that you trade in a way that suits your life. If it's going to be a real struggle for you to day trade at 7 a.m., I wouldn't do it, because even though I might trade at that time and you see my charts and say, oh, Cory's doing good trading at 7 a.m., I'm going to try to do that. If it's not going to fit your life, then it's not even worth starting. Trade at a time that works for you, a style of trading that works for you, and then develop it around your life. Because ultimately, trading is about getting a better life. You don't want to end up where you're in a situation where you're trading and you're miserable because you're trying to do something that just doesn't suit your life or your circumstance. So things to know. Trading is not like other jobs where activity is viewed as good and doing nothing is frowned upon. In trading, following a process is success. It's not necessarily about the result of that trade. It's, did you follow your process, and that's success. If I was hiring traders, let's say one guy comes to me and says, oh, I made 100% last month. Great. Another guy says, I didn't have a great month, but I compare their results to their strategy, and the guy who made 100% basically just got lucky on one trade and actually held a loss way offside, and it just happened to turn around and he made a big profit, and that was it. So he basically broke his rules and made some money. Whereas the other guy followed his process and the results just didn't come. I would way rather hire the guy who followed the process and the results didn't come, because you can always fix the process. You can fix the strategy. You can make the strategy better. That's a pretty easy fix. Whereas the person who's constantly breaking their rules, that's a mental thing. That's going to take a lot of work to improve on. So I'm going to hire the guy who can follow the process, even if his results aren't great, because all you have to do is put a better process in his hand. The guy who doesn't follow, or the girl who doesn't follow the process, much more work there, and a higher risk trader to hire for sure. So follow your process. Overcoming an impulse is work. So we have to change how we view work. When you're sitting there kind of sweating it out, even if it means not trading, so you've noticed conditions are not good, and you have that impulse to trade, and you stifle it, and you're able to talk yourself through it. I use something called commentating, where I'll notice an emotion that comes up, and I'll say, I'm definitely feeling like I'm antsy and I want to trade. I'm just sitting here doing nothing. I want to hit some buttons, make some money. I have to counteract that. So I'll talk myself through it and say, that generally hasn't worked out well in the past. That's work. Going through that process is work. Whereas most people think of hitting the button is the work, but the talking ourselves through trades, making sure that we're following our trading plan, that's the work. And it differs from other styles of work, or going to a job in a cubicle or whatever it is, because they expect you to be pounding keys all day or doing something tangible. But in trading, it's not always tangible. Sometimes doing nothing is the best approach. So we need to change our view of work when it comes to trading. That's sometimes going to mean hours or days if we're a day trader, or weeks of no work if we're a swing trader. Sometimes market conditions aren't good for extended periods of time, and we just might not have any opportunities. If we've reframed it so that we realize we still put in work, in the sense that we were there, we were talking through our trades, we followed our process, that's work, even if we don't have necessarily a monetary result, or it might even be losing money some days. That result isn't so much important. It isn't the action of pounding the keys. The real work is all that other stuff, reviewing our trades, going through our pre-trade routine, following our strategies, and talking ourselves through all that when emotions or thoughts come up that try to detract us from that or get us away from those good habits. Bringing ourselves back to those good habits is the work. At some point, you will need to work on yourself. Accept this now. There is no point starting to trade if you're unwilling to work and admit on your faults. We all have faults. We all have defaults for whether we're more likely to overtrade, whether we're more likely to undertrade, whether we're likely to be impulsive, whether we're likely to be greedy, whether we tend to move our stop losses when we aren't supposed to, let our losses get bigger. If we constantly are trying for that big win and we're always moving our profit target, and so that it never ends up getting hit, and then we give back all our profits. All of us have something. And when we start out, we usually have lots. This goes back to that learning phase thing. We usually have loads of mistakes, and we need to work on them, and that takes time. And then as we get better and we work on these problems, I recommend working on them one at a time to get better, and then that one's no longer a problem. Now we move to the next problem. Then we can start to progress as traders. But if you're unwilling to notice those faults and you're always just blaming the market, there's no point even starting. So accept that trading is actually a mirror for self-growth, because it's going to force you into situations that are uncomfortable and that are going to expose issues that we have. And if we're not willing to work on them, there's no point. If we are willing to work on them, that's, again, what trading is. That is the work that we talked about up here. That is part of the process and part of being a successful trader. Our trading plan and processes should evolve when necessary. Such updates occur outside of trading and are thought out, researched, and vetted against our personality and circumstances. Why I put this in is because a lot of people think, I read this method and now they are like so staunchly stuck to it that they can't even see that it's not working for them, or that there's a better way to do things. So we talked about this earlier by looking at your own trades. I'm constantly reviewing my trades and trying to see if there's a better way of doing things. And sometimes there is, sometimes there isn't. And because you actually want to find something concrete over a large number of trades that says, yeah, if I did it this slightly different way, that would actually increase my profit generally. So if we're not doing that, and we just read an article or something, and it's like, I'm going to follow this method forever, and this person said it worked great, so I'm just going to stick to that. That's a very lazy way to go about it, and it's probably not going to work. You will have to analyze your own trades, because again, even if you're following the exact same strategy as someone else, the probability that you end up in the exact same trades at the exact same price is zero, because in markets, prices move very quickly. So you might even end up in the same trades, but maybe you're a hair later in your entry than they are, or a hair earlier. Just slight differences. So you have to look at your own trades, because that slight difference may mean the difference between you getting stopped out and they aren't stopped out, or something like that. So you want to analyze your own trades and then go through, how can I improve this method? And then we're going to update our trading plan, update our strategies accordingly. And of course, we want to make sure that we can actually implement these changes. So if it's a drastic change, again, like you say, oh, well, I'd make more money if I traded at 7 a.m. instead of 9 a.m. where I'm trading. That's a great idea, assuming you can actually implement it. So you want to vet it against your actual circumstances. And a lot of people find this, they like the idea of a method, but then they go to implement it and they find their personality at this point just doesn't allow them to do it. We'll talk about that a little bit later on, because there are ways. Most people are trying to make a big jump from something they can't do to all of a sudden performing it very well, and we want to make incremental little improvements. So the main takeaway here is that your trading should evolve. You should be learning new things, but I recommend learning it from reviewing your own trades and doing your own research into your charts and finding how you can improve your strategies, not necessarily just reading 100 more books. You can only ever trade at the level you are at, then progress incrementally from there. Avoid trying to make the big leap. So this is what I was kind of mentioning here with someone who might not have the personality for a strategy right now, so they just outright dismiss it. But the fact that we couldn't make the leap from absolute novice to pro trader in 2 days, which is what most people expect when they read a course or go through a course, they think, once I'm finished this course, I'm going to be a great trader. No, because you need to incrementally progress. Whether you're looking at one of my courses or reading one of my books or watching a video or looking at a chart or someone else's charts or courses, they got there by slow improvement. They started somewhere and then they incrementally improved. Then they incrementally improved. It's almost never an overnight, I was an unprofitable trader. I had this one startling realization, and then I was a millionaire a few days later. It just does not work that way. It's incremental. So an example of this would be, you read my course, and I'm using a 2 or 2.5 to 1 reward to risk. So I take an entry, my stop loss goes here, and whatever that, if I'm risking 10 cents on a stock trade, my target's going at 25 cents multiplied by however many shares you're trading for your account size. So now someone views that and says, okay, I should be using a 2.5 reward to risk. And yes, that is where you want to get to. But let's say you start implementing the method and you have your target out there and the price is oscillating around and you're just always closing it early. Or as soon as the price pulls back, you're closing the trade. You're just, it freaks you out having to hold till that target. Now, is holding till 2.5 doing you any good in this circumstance? Because you're not following it anyway. So you're better off to look at, where do I start to feel that bit of panic? So maybe if you're risking 10 cents on a stock trade, you put your target out at 10 cents. So you have a 1-to-1 reward to risk. Now that is not what Cory said to do, but it is where you're at. That is, after that, once the price starts moving more than that, you just start freaking out if the price pulls back at all. You're afraid of losing the money you've made. So it might be better to start with a smaller reward, knowing what we talked about before, that you can always progress and evolve. So start with the smaller reward so that at least you get used to having that target hit within your own comfort zone. Then do that for a week. And then the next week, move your risk reward up to 1.2 or 1.1. And then get used to, you're going to be in that trade probably not that much longer, but theoretically a tiny bit longer. Then you get used to that. That's now part of your comfort zone. Then the next week, you maybe move it up to a 1.4. You're getting closer to where the strategy should be. Because when I post a strategy, I'm usually looking at, I've gone through quite a bit of this process of refining it, and I've come up with an ideal reward to risk for the methods and the market conditions and all that. So you're getting close to that, but you're not quite there yet. So you want to keep incrementally pushing yourself, expanding that comfort zone, so that eventually holding for a 2.5 reward to risk is no problem. But that's going to take some time, especially if holding till a 2.5 reward to risk is very difficult at the beginning. With my swing trades, I'm pushing out, my average reward to risk is about 5-to-1. So that's, a fairly big move for a lot of people to hold through. And that's why I recommend kind of in the swing trading course that, 3-to-1, a lot of people can take it there. Those are going to be hit fairly quickly, but you might not even be there yet. You might be at a 2-to-1 or 1-to-1, and you just need to start there. Put your reward to risk there where you're comfortable, and then slowly expand it over time so that you can get to the point where the strategy does its best. And again, you'll also, going through this process of looking at your trades, may also find that the reward to risk you're using or that you've worked up to is working just fine and you're happy with it and there's no need to go any further. Or you may find that, I could do a little bit better if I expanded that reward to risk a little further, and we're going to do it incrementally. The same thing happens with position size. If, as our account grows, typically so will our position sizes. But we do hit a point where all of a sudden that position size is in our head. We're like, ooh, that's a lot of money. And we might start trading poorly because of it. Instead of just always making the big jump, or maybe we get an influx of cash, we got a bonus. So all of a sudden you throw a whole bunch of money into your trading account and it's now double what it was before, should you instantly double your position size? If you're comfortable with that position size, with your new position size, but it might be better to incrementally increase it. So if you were trading, let's just say 100 shares last week, don't just make the jump to 200. That's actually a 100% jump. That's big. Go to 110 shares. Go to 120 shares. If you were trading one Forex lot last week, one standard lot, don't just make the jump to 2, even if your account doubled. If you're comfortable with 2, trade it. But if you start worrying about that position size, then go to 1.1 or 1.2. And then the next week, go to 1.3. And then the next week, go to 1.4. You're going to get to your goal eventually. And you're going to do it in a way that allows you to stay within and just slightly expanding your comfort zone. But if we try to make the big jump, we're usually going to end up taking steps backward, where you started trading one standard lot, now you've got a bigger account, you make the jump to 2, you freak yourself out, you have a bunch of losing trades with a big position size, and now you're going to have to scale back anyway, and now you have to make back all those losses. And I just find it's better to incrementally go from where you're at to where you need to be, as opposed to always just what you read going from where you are to what's recommended. Can be a big jump and a really hard jump, whereas if you do it incrementally, you're much better off. A few last things. Trading attracts many people because it has very few boundaries, and most people think you can pretty much click buttons any way you want. You've seen lots of charts rising. It's like, if I click the button at the right time, I make some money. This attractive quality is actually a trap, because people think they can just come in and do anything and that's going to be a great life. And that's actually not the case, because it actually means now you need to create the boundaries. It's like working for yourself. Before, when you were in your cubicle, someone came in and said, you have to be here for these hours and this is what you have to do. And then if you go work from home, all of a sudden no one's telling you what to do. Or if you want to start your own business, now you have to decide, okay, how much am I going to work? I need to get this amount done each day. You need to create your own boundaries because no one else is doing it for you. And trading works the same way. Successful trading is actually a form of massive restriction on what you can do. And the kicker here is that it's in this arena that lets you do pretty much anything you want, including destroy yourself. No one is going to care if you blow up your account and lose everything. Your family might, but no other trader, no one else in the market is going to care. Only you care. So trading is a massive restriction, self-imposed on what we can do. We have to put our stop losses out there. We have to control our risk on every trade. And each week even, there's, it's just protocol after protocol after protocol. If I'm feeling anxious, or I'm feeling FOMO, or I'm feeling greedy, I have to impose things on myself to try to regulate that. I have to go through that talking I was talking about. The commentating, where I note these feelings and come up with a way to make sure that they are not self-destructive to my trading. So people come to trading for the freedom, not realizing that we need to come up with rule after rule after rule for ourselves and religiously follow them. And if we get back into this, trading, I can do whatever I want, I'm going to ignore my rules today, we risk losing everything and not being able to trade. Freedom is actually found within rules, not a lack of them. And you could think of certain countries where you can pretty much do anything you want. But also other people can do whatever they want. So if you go walk out on the street and look at people wrong, they might just shoot you. Trading, kind of the same way. You're in this minefield, so to speak, of potential problems where you could have big losses, and freedom is found in creating rules that prevent those losses, that take profits when you're supposed to. And yeah, consider the type of freedom you're looking for. If you just want to do whatever you want, trading is not for you. If you're looking more for specific types of freedom, like financial freedom, or just more time, so freedom in terms of time, then trading could be of benefit if you realize that you're only going to get those things with a lot of rules imposed on you, and you are going to have to self-impose them. Trading also attracts people desperate for results. We've talked a little bit about results versus process already. People who succeed are driven by routines, processes, self-discovery, learning, improvement of their own ideas, not endless searching. At some point, money needs to become secondary to process, at least while we trade. The result isn't so much the important thing. It is following the process, as we talked with the traders. If I was interviewing traders, I'd want to hire the one who follows their process, not necessarily the one who just has the best results. It is during our reviews and our strategy developments. This, you can think of trading as there's the time when you actually sit down to place trades and you're hitting buttons and placing orders. And then we have another time, which is outside of that trading time. We want to create separation, a wall between these things. You have your trading time, which is implementing your current strategies as they are now. And then maybe you have some time in the evening or at a different part of the day where you do your reviews and you look at maybe developing new strategies or improving on your current strategies. And that's when we can focus on the results, in that separate time during our review, during our strategy development. Because then we can actually look at ways to improve our strategies. We can look at charts. We can do some back testing. We can do some research. But until that's done, we follow the strategy that we're following. This is how the trading evolves. We talked about how your trading should evolve over time. It does not evolve by making on-the-whim decisions while we trade. Instead, we follow the plan that we've laid out. Then we can do a review to see how that worked. We can find ways to improve on that outside of the trading. And then when we come to a decision, we update our trading plan, we update our strategy. Then we go back to our trading, we implement the new method, and the process keeps repeating. So we're always following our process while we're trading, and then the results part comes in during that review, where we can find better ways of doing things to potentially make more money. So a few last things. Joining the winner's circle, there's no guarantees of success. 95% of people fail to make a livable income from short-term trading, and it's about 75 to 85% fail to make any money at all. So 75% fall in the basically losing category. 75 to up to about 95% are making some money, and that's of course going to be a scale where some are making quite a bit, some are making very little, and then kind of at this 70s, at about 76 or 77%, they're probably not even justifying their time for trading. They're making a little bit, but putting in 2 hours a day, they might only be making like a couple dollars an hour or something. Whereas people closer to this 95%, maybe they're not quite in the realm of being able to make a livable income, but they're producing a very nice side income. And then you have some people that are making a living off their trading. And again, that's going to be a sliding scale. You have people who are making millions to people who are making and able to live off, a few grand a month. So it's very variable. The thing about this is that you've now learned a whole bunch of how to efficiently trade and how to get into the winner's circle. Most people don't understand this. or they have poor execution of being able to actually do all the stuff we've discussed. So these people end up falling into this group where most of them end up failing. You at least now have a little bit more insight into how to get into this winner's circle. Now that doesn't guarantee that you'll be in it, but at least now you have a choice, and if you follow the steps, you're much more likely to get into that group and follow through on all the things we've discussed. What we put in is what we get out, but this is often misinterpreted as well because it's not just putting in hours. It's about efficiency, following a process, noting and improving on mistakes, a 1 or 2 strategy focus, especially at the beginning, not trying to incorporate everything at once. We're going to have to do a lot of internal work, noticing where we're making mistakes and then finding ways to improve on them. Again, I'll post links in the description below the video. Evolving as we make new discoveries, that partition between when we're trading and doing our review. Trading is about following a process. When we do strategy development, research, reviews, that's more about optimizing results. And incremental improvements create great traders. As soon as we try to make big jumps, we're often going to end up setting ourselves back. We want to work toward a goal and start where you're at and then try to incrementally improve it. Being great at anything is hard, but it is doable, and I hope now that you have some insights into whether you're up to it and how to progress efficiently. For loads of other resources, you can always come to tradethatswing.com and also check out the resources below the video. And if you like this kind of content, please hit the like and subscribe button.